From a retirement planning perspective, one of the biggest decisions you're going to have to make is when are you going to start receiving Social Security benefits? And if you have a partner, when are they going to start receiving Social Security benefits? And how is that going to impact you and your family and your legacy, etc.? I see people that come in all the time, prospects, new clients, and a lot of people get Social Security wrong. There is a lot of misinformation out there. I mean, I'm hearing things. I mean, I heard someone the other day saying, "Oh, Trump got elected. Social Security is done. I'm not even going to think about it. I just want to start taking my benefit now because it's going to go away." Okay, maybe, but it's still here now. So we don't want to worry about that. No one has a crystal ball. We have no idea what's going to happen. And you have the flip side. Some people are like, I'm just going to wait till age 70 because I heard at age 70, I get the biggest benefit and it's what I need to be doing. True, but that might not be best for your situation. So today we're going to be talking about Social Security optimization. I'll share a live case study on how some clients are leveraging certain planning techniques to help them build wealth and help them put more money in their wallets versus give it to Uncle Sam. Also, I'll provide you some key considerations, things that you should be thinking about as you develop your plan, because everybody has a different financial plan, or like to call wealth plan. Everyone has different goals, aspirations, different financial accounts, different ideas, spending habits, etc. So what I'm about to tell you is general information, but hopefully it sparks some interest in terms of how you should be thinking about your plan and things that you can do to help optimize your overall Social Security and wealth plan. Now, before we jump into the case study, I wanted to share some key figures or key numbers that I provide my clients every single year. And these are numbers from the IRS. And what I want to show you here is specifically around Social Security and earnings limit. So what you'll see here on earnings limit, you say below FRA 23,400 and then reaching FRA 62,160. So Eric, what the heck does this mean? Well, what this means is the IRS is saying that if your full retirement age, let's just say for example, is 67, that's when you'll receive your full Social Security benefit. But you start taking Social Security early. Let's say you take Social Security at age 62, which is the earliest, but you still want to work, maybe part-time or full-time, but you don't do any planning. You're just like, I just want to get my money and see what happens. I want more money. Usually why people claim early. So you start receiving at 62, but the problem is you're still working and there's a 23,400 limit here. So what they're saying is if you make more than that 23,400 limit, then they're going to start withholding $1 for every $2 of Social Security benefits. So let's say, for example, to keep the math easy, you make $33,400 in wage income, so part-time or full-time income. So you're over the cap by $10,000. So that means they're going to withhold $5,000 of your Social Security because you went over the earnings limit. Okay. So again, taking Social Security early might not be the best thing for you because you might be reducing your benefit. Now, the year you reach your full retirement age, so let's say the year you turn 67, so let's say you turn 67 in whatever, July, and it's January. Well, that year, the limit is increased. So now it's 62,160. So if you make over 62,160, then they will withhold $1 for every $3 you make over that limit. So it gets better, and eventually they recalculate your Social Security benefit, but not knowing these limits and not planning for them can really make an impact to your cash flow. So that is a key thing I just want to share, is just understand what your earning limits are, because maybe that will help you determine whether you or your spouse are going to continue working, or maybe you're going to flat out retire. Because at the end of the day too, if you retire before your full retirement age, but you're not making nearly close to this earning limit, like you're well below 23,400, then you'll still get your full Social Security benefit. Same goes for here. If you're making under the 62,160 and you want to take Social Security that year early, you're still going to receive your full benefit. So again, just a really key consideration I wanted to share there. Now, if you want to figure out what your full retirement age is, I mean, the easiest thing you can do is you can go to ssa.gov. and you can pull your Social Security statement. It will show you there, and it will show you what your benefit payout will be at age 62 or 66, 67, age 70. It will tell you what your benefits will be. But for the sake of this conversation today, you can see what your full retirement age is here. So if you were born between 1943 and 1954, your full retirement age is 66. So that's when you can start getting your full Social Security benefit. 55 through 59 essentially is age 66, and you just add a couple of months. So 55, 66 and 2 months, and then 56, 4 months, 57, 66, 6 months, etc., all the way going down the chart. And then if you were born at the year 1960 and after, then your full retirement age is 67 years old. So just some key numbers there. Now, I want to share a live case study. I want to share how having a comprehensive plan can really optimize your Social Security strategy and also put more dollars in your wallet and your family's wallet. So first things first, we have Laura and Chris client sample here. Clients here, when we look at their ages, they're 68 and 74. When we look at their goals, they want to retire. Laura at 68, Chris is already retired. They want to have a retirement income of about $15,000. They also want to plan for healthcare, so close to about $12,000 for retirement healthcare costs, and then also potentially long-term care costs as well, because there's some dementia and illness in the family. So $68,000 and $68,000 for both of them respectively. That is just a national average. And then they also want to plan to go on vacation every year. They want to spend about $40,000 every single year for about 15 years into their retirement once Laura turns 68. So now that we know that, I'm going to share what their net worth is. So their net worth is roughly around close to $4.6 million. They have $482,000 in the bank. They basically have no debts. They own their property outright. And from an investment perspective, they have a little over $3.1 million, where a majority of this investment money is in pre-tax 401k and pre-tax IRA, and a little bit in a trust brokerage account. So now that we know their general situation, what we want to do here is we want to start talking about Social Security optimization. So one planning technique that you can do, and again, I'm not saying this is advice for you. Everybody has different scenarios and situations and goals, values, etc. But in this particular client, so it turns out that one of the partners is higher income. So that's Laura. So Laura's higher income. Laura's been higher income their entire life. So she's opting to follow the advice to wait until she's 70, because if something was to happen to her, her spouse, the lower income earning over the lifetime, would be able to get whatever's higher, either her benefit or his benefit. And so her being the highest one, and knowing what you know here is that they have a good amount of retirement assets. They don't need the money. She doesn't need to start taking Social Security at her full retirement age or take it earlier. She can afford to wait to age 70. So by doing that, she's optimizing Social Security. She's going to be earning more, which I'll share here in a second. And with him, he retired early, so he's already automatically getting this guaranteed cash flow. He's not working at all, so 100% of his Social Security is not being withheld and not included in any of his taxable income. And so when we look at Social Security optimization, though, what we're seeing is, because she is waiting to age 70, well, now that is going to increase their benefit to $201,000 more. So really, really impactful to just wait until she's age 70. And when we look at tax strategies around this too, so another reason why we want to incorporate tax strategies when we're talking about Social Security is because we want to try to limit as many taxes as possible. The goal is to have as much after-tax income in retirement as possible. So what can we do to limit the after-tax income, right? Or I'm sorry, increase the after-tax income. So one of the strategies that we can do is we can do a Roth conversion. We're removing money from a pre-tax account and converting it to a tax-free Roth account. So as you'll see here, we have a window from when Laura's 67 to essentially when she is roughly about 72. So we have a window in which we can do a series of Roth conversions. So that's what we see here. We see this green line here, what we want to do is we want to be able to fill up her tax bracket when she gets to, roughly the 22 to 25% tax bracket. We want to start pulling money from the pre-tax accounts, converting them into Roth accounts. So by doing so, we are going to be increasing ordinary income, but we're not going to be going higher than this 22 to 25% tax bracket. And so by doing that over this said period of time, and by moving money to the Roth accounts, we're going to be able to provide an additional $2 million in the tax adjusting assets just by doing a couple of different tax strategies. Now, all of this is not just because of these Roth conversions. There's also withdrawal strategies. There's also allocation strategies. But for the sake of this conversation, we want to try to limit as much of our income as possible in the future so that our Social Security is never taxable and we don't hit the thresholds that could trigger more taxes. So by doing this here, we can have a good step forward in terms of ways to minimize taxes. Now, because we're doing this so well, because we're also doing other tax strategies, but specifically with these conversions, what we're doing is, from a federal tax perspective, we're also saving over $700,000 in total federal taxes paid by just doing some Roth conversions and lining this with withdrawal strategies and Social Security optimization. So very, very crucial to look at this for your situation and see, okay, well, does this make sense for me? Because if it does, I mean, we could, like as demonstrated here, this could be a 6-figure plus savings from a tax perspective. So another thing I'd like to share here too is that when we look at the total cash flows and when we look at their net worth over time, so even doing the Roth conversions, maybe taking a little bit of tax hit at the beginning during that retirement window, what we're doing here, we're still seeing a significant amount of their assets growing. And if we look at their net worth, over time, we're at $8.2 million. Now, that might seem like a lot of money. It is a lot of money, but this would be much lower if we didn't optimize Social Security, if we didn't do any tax strategy, and if we didn't look at our plan holistically with our partner, if you have a partner, to really make sure that we're in a good place to save on taxes and continue growing our wealth. So very, very, very important that we look at these different considerations and that we have a customized plan, because when we go back to the tax strategies here, we're not thinking about tax strategy just 1 year or 2 years. We're looking at taxes all throughout retirement. We're iterating. So from a conversion perspective, we're looking at in this case, from 2026 to 2030. So during this period, during this 5-year period, if you will, we are going to be converting set amount here into the Roth accounts. And then after that, there are no more conversions available. So if we miss this window, this is the power of tax planning. If we miss this window, this can be the difference between having, in this case, $344,000 tax-free, at age 73 and 81, and not. So that can mean a lot, especially if tax rates are higher in the future, which all signs are pointing to yes, they will be. We don't know, but essentially, by having withdrawal strategies, tax strategies, building up our tax-free accounts, we can really increase our overall financial well-being and net worth. And again, it's all about perspective. It's all about thinking about, okay, from a Social Security perspective, does it make sense to take it early? Does it make sense to take it late? Are we going to go over the thresholds? Are we going to increase our taxes, lower our taxes? Is Social Security going to be included in our taxes? Are we, in a place where we can pull money from different tax buckets? As I've mentioned in previous videos, do we have enough tax-free accounts? And more often than not, there's so many nuances in retirement planning, specifically Social Security and tax planning. Nobody really gets into the weeds around these things. And so that's why it's important to just, for me, my goal is to bring awareness around some of these ideas and strategies so that you can consider them and now start planning for them. So hopefully this provided some really good insights for you. Hopefully that you gives you some ideas on what you should be looking at from your retirement plan. What are some moves that you can be making now? And like I said, it's never too late, at least to start thinking about and customizing your plan. If you're already in retirement, that's okay too. That's totally fine. You can still iterate, but ultimately, the best thing you can do is, if you're 50, 55, 60 years old, I mean, you have plenty of time to really flush all this out, and we can really create a crystal ball for you. You can determine your withdrawal strategy, your investment strategy, social security strategy, tax strategy, etc. You have so much time to do it. Versus if you're in retirement, you don't have that much time to do it, but you can still do it. There are still ways where we can lift the hood, if you will, and really get our hands dirty and figure out, okay, where are some levers we need to pull? What are some opportunities that are still out there, and figure out how you can put some more money, as I mentioned, back in your wallet. So hopefully you got some insights here. If you have any questions, post them in the comments below. I'll be happy to answer them. If you have any questions, feel free to reach out. You can go to the website, wealthbellc.com. Feel free to book a call with me if you are considering retirement planning, or if you want a comprehensive Social Security and tax plan. Happy to have that conversation if it makes sense. So thanks so much for joining me today, and I'll see you next time. Cheers.